Hello and welcome to the Kingsview Wealth Management Q4 Portfolio Review and Investment Outlook. My name is Scott Martin, Chief Investment Officer at Kingsview Investment Management. Joined today, familiar face again, Paul Nolte, Senior Vice President and Portfolio Manager at Kingsview Investment Management. Paul, I know you have a busy schedule as usual. Thank you for taking time out of it to join us today and talk about a few things going on in the markets and economy and calendar, if you will, as we kind of look around things today being close to mid-January and just the machinations and the goings on in the markets. Talk maybe a little bit about where we've been, let's say, in the recent months towards the end of last year, 2019, and kind of where we sit today as we record this piece, talking about the markets, economy, and some of the things influencing it, please.
You know, it's really an interesting fourth quarter, an interesting year last year. Fourth quarter, I think there were 2 down weeks the entire quarter. So it was straight up, and it really came based on the Fed. The Fed said, hey, we're going to be stepping aside right now. We're going to run things a little bit hot. We're good. So similar to your parents taking off for the weekend and leaving everybody
I remember
home.
those days.
And so the party was at your place. And so that's what's happened in the equity markets. The party is on. And the equity markets did a fabulous job. They were up almost 9% for the quarter, which is actually a pretty good year. And we didn't get any help really from earnings. So it was really very much a liquidity-driven market. The interesting part is we got participation from a lot of other areas. Bonds did well, international did well, emerging markets.
Commodities too. Gold at least, yes.
So we got a lot of asset classes. So diversification really didn't hurt and actually probably helped a little bit in the fourth quarter. And I think that's going to be a theme that carries through to 2020.
Yeah, you mentioned something. I mean, the fourth quarter being 9% or so, give or take your favorite index, is usually a good year. Yet you add that on to how the S&P and some of the indexes we watch under what the performance was for Q1, Q2, and Q3, you're pushing close to 30% total return, which is amazing. You mentioned bonds. That's the interesting thing, because you're right, and it does harken back to some of my high school days when my parents would leave and then the party would really start, similar to how the Fed did that, because the markets, especially the bond market, told the Fed, hey, you guys need to be cutting rates in 2019. This is going all the way back to, say, this time of last year, right? About a year ago, when the Fed had been a little bit more hawkish and then the markets had freaked out. So let's talk about interest rates and how they behaved throughout the year as the Fed gave us 3 interest rate cuts.
Yeah, it was interesting because you're right. When we got to the beginning of the year, the Fed pivoted and said, oh, by the way, we're going to start cutting rates. We're not comfortable with the way things are going. And then as we got into the fourth quarter, they kind of ramped up a QE light maybe in the repo market. There were some issues there, so they injected some liquidity. So the Fed was very much the wind in the sails for the equity markets, injecting a lot of liquidity, cutting interest rates, and an equity market loves low interest rates.
Especially other central banks around the world too, cutting rates and also injecting that same liquidity.
Yeah, we were by no means the only one. We were kind of late to that.
We're the last, we were the last party going, maybe.
We were the last ones into the party. So again, the markets did very well as a result of that. So now what the Fed has basically done with their last missive in December said, we're going to be away on vacation for entire 2020. And to be honest with you, they probably should, only because everything is politicized.
Yes.
And no matter what they do, whether they cut rates or increase rates, it's going to be seen as political. So they are likely to be out of the picture right through the election.
Yeah, and I think that's a good point about just how key the Fed had played into the market's performance, certainly last year, but especially in Q4 as they stepped away, as you mentioned it, because in our portfolios, we were not afraid of rising interest rates. We were not afraid of equity markets too much, especially as the Fed started to get it right, let's say. We added to commodity positions throughout the end of the year and even in Q3 because of the fact that we saw this liquidity benefiting a lot of the commodity space too, because of that rush of liquidity that went in there. So now as we sit here in middle of January 2020, what are we thinking with respect to how some of those asset classes are going to behave amongst each other, and maybe other asset classes might start to behave maybe a little better even this year when it comes to international value?
Yeah, and that's one of the things that we started to see in the fourth quarter last year was a return, if you will, after 10 years of the S&P being the dominant asset class, or the dominant asset, to now diversification paying off. And I think that's going to be the theme that we have going forward, is diversification is going to once again pay to be diversified, to be more value, to be a little bit more international, more emerging markets, some commodity exposure. Anytime you did that in the last 10 years, you hurt performance.
Yes.
And I think you're going to actually help your performance this way. So the kind of the theme, if you will, is anything but the S&P 500. Not necessarily the next couple months, but I think over certainly the next couple years, and we're starting to see the early signs of that transition.
Yes, I'm really interested, especially now. And yes, there's some geopolitical tensions going on and heating up and then cooling off depending on the day. But I'm very interested to see how some of that international positioning works out. I mean, international growth stocks, yes, international value, small cap. I mean, there's a lot of things out there, internationally speaking, that look like they're ready to start be very interesting. We sit here also, Paul, amidst that geopolitical tension, a presidential election cycle being year 4, so we have an election here in a matter of months. With respect to data points that are coming out in the next, say, couple months or few weeks, really, we've got a lot of focus on retail sales, certainly a lot of focus on the consumer, CPI too, given where the Fed is now, inflation numbers. What are we thinking about with respect to, say, some upcoming economic data points and how they may behave vis-a-vis how they've acted, say, in the fourth quarter and Q3 as the Fed has stopped cutting rates?
Yeah, we've seen inflation kind of pick up. So if you take a look at some of the Fed favorites, you take a look at the Cleveland Fed, their median inflation number is running a little bit above the 2% level. You look at wage growth. Wage growth normally is between 2 and 4, running at about 3.5.
Yeah.
So you're looking at some of the other factors. We're seeing pickup in commodity prices. Year over year, commodities are now on the positive side after being down for much of the last 2 years. We're seeing a pickup in steel. We're picking up in iron ore, certainly oil. We're seeing it in gold. So a lot of the commodities we're seeing pick up as well. That will also help the emerging markets and international scene. The other part of it is the dollar has come down now as the Fed has stepped away. So the dollar may actually come down in value. That will help some of the international stocks. That will certainly help some of the big international players in the US. So there's a lot of things that are going on right now in the next few months or so that we're going to be keeping an eye on. Inflation certainly being one, wages, wage growth being number 2, and then really what the Fed does decide to do. They're still going to have some meetings. They're still going to be out in the rubber chicken circuit, if you will, making their comments and stuff, and we'll be paying attention to that. But I think essentially the Fed is going to jawbone more than they are going to act this year.
And on currencies, the dollar looked like it did get overdone to a degree last year. So it does make sense to us that there's going to be some come in when it comes to the dollar and just some retracement vis-a-vis some of the other G7 currencies. And that's really something too, is that when you think about the greenback and you think about really actually the plastic, let's say, that's in the consumer's wallets these days, because everybody seems like they're shopping online and using credit cards versus anything else. The consumer is one area that we're really focused on in our portfolios, in the sense of seeing how the consumer is doing and how that leads the market. And I believe that, as you mentioned, with some of the great job numbers that we have, wage growth numbers are okay. They're not fantastic. In fact, a lot of our models suggest internally that wage growth numbers should be stubbornly a little bit higher than they are these days, given where we are in that employment cycle. And then if you look at GDP and how that's translating through consumer spending numbers too, I believe the consumer, especially too, given the fact that the markets themselves and 401k numbers and even home value numbers, which have been decent and certainly stabilizing in markets that have been falling previously, looking at some of those figures internally, if you're the consumer and sitting at home, you're going to be more motivated potentially to be spending money in 2020 because of the fact that you just feel good about your situation and you can find a job if you want a different job. If you're looking for a job, it seems like employment's out there for you.
It is. And when you do look at the retail sales, and we tend to look at more a year over year number, they're running at a 4 to 5% rate. So again, that's very good. When we take a look at the leading economic indicators and we focus in on the consumer portion of that, the consumer is still pretty confident about not only today, but they're also confident about the future, and that's important. As long as that continues to hold, I think we have a very good outlook. When the consumer starts to fear for the future and be a little bit more concerned about the future, then we're going to be worried. The last part of that is, when it comes to spending, is energy prices. So prices at the pump, they've been relatively stable on a national level most all of last year.
Sure.
And, unless we see a spike there, and we really are not projecting that, that would be one of the other things that could dent consumer confidence
Yeah.
a little bit.
One thing to finish up here, and I'm surprised you haven't said this yet. I've been trying to lead you to it, but it's the year 2020,
Yes.
which means
This is the year of perfect
yes.
vision.
So this is the year we're going to get everything right. Is
Yes,
that what we're saying?
exactly.
So given that, and not that I want to predict the presidential election that's going to occur here in about 10 months, but I still that still feels like a big issue to me that the markets are going to have to work out to some degree, or that there's going to be some handicapping going on as we go closer to it. How do you believe the presidential wins, let's say, as they blow different ways, are going to affect equity markets, or maybe just in general, say, or even fixed income markets, but also maybe just in general affect volatility right now?
When you take a look at the history of the presidential election year, the markets tend to do poorly first quarter, first half of the year, and even into the election, and then ramp up afterwards. Once
Like a relief rally,
kind of a
once the
relief
news is
rally,
out.
Once we know who the president is going to be.
Right.
So you get that uncertainty. The spending has occurred to juice the economy. The incumbent always does this. They want to get the economy going so they get reelected. That's the first job of every politician. And so certainly that has occurred already. We've seen it in the equity markets. We're seeing it in the economy. This year it's going to be tough. So again, typical election year, there is going to be some volatility probably first half of the year. Also, the first quarter of the year has historically been weaker. And I think a lot of that comes down to consumers who are spending a lot more on healthcare out of their pocket. They have to meet their minimum requirements, et cetera. And that usually occurs first quarter, first half of the year. Once they meet their minimums, a lot of that then is paid for by the insurance company. And so they have a little bit more money in their pocket last half of the year. So maybe a quieter first part of the year. Markets may trade sideways to down a little bit first half of the year. And then typically, if it follows according to the historical ranges for the election cycle, we'll see a back half of the year that finishes pretty good.
Yeah, and these days, though, it seems like it's anybody's guess. I mean, things have tended to go kind of almost the opposite, so we'll certainly pay attention to a lot of those factors as they go forward, as we always do with our investment committee and our other portfolio managers at Kingsview, Paul, keeping an eye on the day-to-day changes, certainly the week-over-week changes, and then the monthly data points, too, to kind of help us lead us to where we want to be positioned for your portfolios and how we want to affect any kind of trades in your asset class positioning. So with that said, Paul, great joining you again, or thank you for joining us, that is, and certainly you do a great job of putting everything in a very chewable, digestible way of understanding for us as we kind of talk about how we manage portfolios here at Kingsview. And thank you for joining us as well. If there's anything more that you would like some clarification on, if you have any questions on things we discussed today, please reach out to your investment advisor or find out more information on us at kingsview.com.